All right, welcome back. This is module 2 of the Fix and Flip class. I'm excited to dive into some of the information that we have in this module. In this module, we're going to be covering mostly definitions that we're going to be using throughout this class, as well as definitions of terms that you're going to need as you're negotiating fix and flip properties, as you're working with your contractors and with your title agents, with your real estate agents. So this is going to be important stuff. You need to speak the vernacular if you're going to dive in and start working in this space. So let's go ahead and get going here. Now, like with every module, need to share the disclosure real quick. I am not a licensed attorney, accountant, financial advisor, real estate broker, real estate agent, or any other licensed individual. This is just really good information that I've had a lot of success with that I want to share with you. So hopefully that works for everybody. Now, let's dive in. Let's start talking about some of these definitions. So I've got these organized in alphabetical order. We'll just go through them like that. The first one is acquisition costs. These are charges and expenses related to the real estate purchase over and above the property's price. These expenses will include, but are not limited to, title insurance, title fees, legal fees, property taxes, liens, municipality assessments, and anything else encumbering the title. It's important to remember that if you negotiate a purchase price of, let's just use the example of $100,000 on a property, remember that $100,000 is not what you're going to be spending, because there are fees with the title insurance and the title fees and all the other things that we listed that are going to show up when you close on that property for purchase. We refer to those as acquisition costs. So you may end up spending $105,000 to purchase a property when you negotiated a sales price with the seller of $100,000. Just keep that in mind. That's going to vary property to property, so you want to make sure that you've got a close relationship with your title agent to make sure that you understand those costs before you go to the closing table. Now let's talk about appraisal. Appraisal is a fee that's charged by an appraiser to render an opinion of market value as of a specified date. The appraiser is primarily concerned with the property's market value. The appraiser will research recent sales of comparable properties in the area, as well as current construction costs and rental comparisons, to calculate the probable market value of the subject property. So an appraisal basically just lets you know what the property is, the property value is as of the date and the current condition of the property. We rarely use an appraisal when we're purchasing a property, because that does not matter. If you watched the off-market deals on tap class, we talked about our finding system and how we get to the purchase price by simply using math. We take the after repair value, which is what we project we'll be able to sell it for, and we subtract out all of our costs from that, including our profit, and that gives us our purchase price. So getting an appraisal when you're purchasing a fix and flip, I rarely, if ever, do that. But getting an appraisal on the back end, usually you're selling to a retail customer, so you're going to need an appraisal, right? It's important just to understand what that is. Now, moving on, building code. In construction, this is the construction, improvement, and maintenance requirements established by the local government to ensure minimum safety conditions. Now, you have to make sure that if you're doing any structural changes to your fix and flips, that you understand the building code. That can usually be found at the municipality office, so at the city office, or at the county office. So just make sure that you're aware of the building code. If you're doing more than carpet, paint, and cabinets to a property, if you're moving walls, or you're putting in new walls, or you're taking out walls, make sure that you're aware of the building code, which leads right into the next definition, which is the building department. This is the municipality's department responsible for controlling, monitoring, and approving building permits. It's unincorporated. In unincorporated areas, the county's building department and zoning board will have jurisdiction. So you need to be aware of where your property is located. If it's located inside of a municipality or a city, then that's who you're going to be working with. If it's located in county territory, unaffiliated with a city, then you're going to be working with the county. But either way, the building department is there to make sure that the building code is enforced. So if you decide to ignore the building code, you're at risk of being cited by the building department. My best advice is, if this is a business that you're going to take seriously, run it like a business. Run everything above board. Get your building permits, get your codes straightened away, which leads right into building permits. This is the authorization for construction or improvement to a property. Local zoning ordinances and regulations normally require property owners and developers to obtain a building permit from their local building permit department or their local building department before any major improvements can begin. These permits require review and approval of architectural plans and blueprints. Again, this is only necessary if we're changing structure of some kind. Some cities require you to go pull a permit if you're going to be doing sheetrock. But the ideal flip, in my opinion, is one that you just paint, carpet, tile, kitchens, bathrooms, which would include cabinets and countertops and sinks. A lot of that stuff doesn't require permits, but it's always good to double check with the building department just to make sure, just to verify whether you need a building permit or not. Because if you do need one and you don't get one, you're at a high risk of getting cited. And most building departments in most areas of the country take their jobs very seriously and are very vigilant about looking for people who are out doing construction and architectural changes to properties in their area and citing those people who don't have appropriate building permits. So make sure that this is something that you cover and know whether you need one or not as you're working on your project. Now, let's talk about carrying costs or holding costs. These are the expenses associated with holding a property until it's sold or able to generate sufficient revenue. This is normally applied by real estate speculators to calculate the feasibility of a potential investment. For example, the expenses secured by a land speculator from the time of an investment parcel is purchased to the time that it is sold comprise the carrying costs for that investment. Let me translate all of that. So what we mean there is it's just the cost of owning a property. If you're going to use other people's money, you're going to possibly have interest rates. You need to understand what those interest rates are and calculate them into your budget. You are also going to need to calculate for utilities, for insurance, for property taxes. Those all fall under the category of carrying costs or holding costs. Again, it's just the cost of owning a property. Now let's talk about certificate of occupancy. Sometimes this is abbreviated as CO. This is a certificate from a building inspector or local government agent that certifies that the building meets building codes and or living standards. This is necessary before tenants or owners can occupy the building. Now, we talked about building permits previously. You need a building permit to start construction, and the building permit stays active until you are complete with you've completed the construction project. Then at that point, an agent from the building department has to come in and do a final inspection. Once that inspection is complete and passed off satisfactorily, then the building department will give you a certificate of occupancy. That means that you've done everything according to the building code and that the city signs off on it or that the county signs off on it. That's what you're going for. That's the end goal of pulling a permit, is getting that certificate of occupancy. Because then if the sellers ask, if you pulled permits and to make sure that everything that you did was in line with the building code, you can show them that certificate of occupancy. And that's always enough to make sure that the sale goes through without a hitch, if that's a concern. So let's talk about chain of title. This is the sequence of title ownership for a real estate property. The local property records office records all owners of the property. When the title deed is investigated as preparation for closing, this is on purchasing a property or selling a property, the title company will sometimes review the chain of title to assure against potential title problems. So in short, chain of title is just simply a list of people who held the title on the property since it was built. So if you've got a 100-year-old property, you may have several people on that chain of title. If you're building a brand new property, then you're going to be the first person on the chain of title. But this is just a list of people that own the property prior to you. Closing costs. These are the charges and fees over and above the down payment that must be paid in order to complete the transaction. This normally includes the origination fee, the appraisal costs, the attorney's fees, the discount points, the title company charges, the credit report costs, prepaid escrow, etc. This varies property to property, and you want to have a tight relationship with your title agent because they're going to be able to cover what your closing costs are going to be before you close on the property. So your closing costs usually are something that you need to worry about on both ends of a transaction, both purchasing and selling a fix and flip. So be aware that those closing costs are something that you're going to need to pay for at closing on both sides, and make sure that they are accounted for in your budget. Now, keep in mind, you can negotiate that the buyer or the seller pays the closing costs. So if you want to work that into your negotiation, that's absolutely a negotiable thing. And you can have the other party pay those closing costs. It doesn't always work out in your favor, but it's something worth going after. And I usually try to negotiate that in. Let's talk about closing statement, the final accounting of a transaction and the funds received and paid. The attorneys representing the seller and the buyer will prepare this statement, which the closing agent will incorporate into the final settlement statement. In my experience, most of the time these closing statements are prepared by the title company. A lot of times they've got either an attorney on retainer or an attorney in-house that handles all of these types of things. So my best advice would just be stay close to your title agent and make sure that you have those closing statements before you close on either a purchase or a sale of a fix and flip property. Let's talk about comps. So a comp, or a comparable in its long form, is a property that's used by appraisers as a comparison tool to determine the value of the subject property. When developing the appraisal report, the appraiser will gather and analyze comparable properties to determine the estimated market value of the subject property. Comparable properties must be similar in structure and nearby to the subject property, as well as having sold or listed for sale recently. Now, I don't like to use listed properties. I like to only use sold properties, because listed properties, the purchase price is subject to change. So we've talked about comparables. I'm not going to spend too much time here going into it, because we talk about it a lot in the off-market deals on tap class. You're definitely going to want to watch that class in conjunction with this one to make sure that you understand how to pull comps, because this is also something that you can do to calculate your after repair value as you're doing your quick analysis on the property, deciding whether or not you want to purchase it as a fix and flip project. Let's talk about competitive market analysis, or as abbreviated CMA. This is a method used by many real estate agents to arrive at an estimated market value for a property. The CMA approach is not as concise as the standard appraisal model. So I often will have, I've got great relationships with agents. A lot of times I have agents sell my fix and flip properties. And because I send my agents so much business, there are times when I have a hard time pulling an ARV for a property. I'll reach out to an agent and have them use their tools that they have to put together a competitive market analysis, which will give me some good comps in the area and allow me to calculate an after repair value, if I'm struggling in my quick analysis phase. Let's talk about general contractors. So this is the contractor that's primarily responsible for supervising a construction or improvement project. The property owner or developer works with the general contractor, who will then hire, manage, and pay subcontractors, as well as the GC's own employees, to complete the project. So general contractors are often needed to pull building permits. So if you're doing a property where you need to pull a building permit, you're going to need to have a relationship with a general contractor. I also like to use general contractors on every project that I do. I just make sure that I have enough money in the budget to cover paying those contractors. But I like to use them on every project, because they can just manage most of the day-to-day project for me, so that I can go out and focus on just picking up more properties, raising more money, and doing more of the investor type things. The more you dip into being a contractor yourself, or a general contractor where you're managing the contractors, that's going to take more time away from your ability to go out and actually do investor-related activities like finding properties, negotiating properties, raising money, and closing on properties. Those are the areas that you want to focus on. So let's put the aces in their places and let the general contractors do what they do best. Let's talk about ground fault circuit interrupt, or GFCI. This is the only protection device designed to protect people against electric shock from an electrical system. A GFCI protection device operates on the principle of monitoring the imbalance of current between the circuits ungrounded, which are the hot circuits, and the grounded, which are the neutral conductors. This does not monitor the grounding conductor, and it will still operate in a circuit without a ground. So a GFCI, it looks very similar to a plug, like a plug that you would plug an appliance into or your vacuum cleaner into in your home. It just looks a little more technologically advanced. It has a test button and a reset button on it. And the GFCIs are important to have around sources of water. So if you've got electrical close to a sink or a bathtub, you want to make sure you have a GFCI plug in those as your receptacle in those ports, because that's going to protect someone from accidentally knocking their hairdryer into the bathtub and electrocuting themselves. So it's a safety device. In most building codes, they're going to require that of you, that you use GFCIs near sources of water. So just be aware of what that is and how it's used. Now let's talk about historic structure. This is any building or improvement that is officially recognized by a government agency or government chartered body as having historic significance. Properties that are officially designated historic usually face special improvement restrictions, but also often receive tax incentives. So historic structures, I know fix and flippers who only focus on historic homes because they're able to get tax incentives which increase the value of the profit that they get on the back end. But keep in mind, if you're working on a historic structure, then you absolutely have to pull permits because the city wants to be involved on what the design of that historic structure looks like. In most areas that I've worked in, usually anything over 100 years old, any structure over 100 years old is automatically deemed an historic structure, as well as any property structure that has an historical significance, that some major historic event happened there or local historic event happened there. The city has the option to deem it as an historic structure. With those historic structures, they want to make sure they maintain the integrity of the history of that structure. So they're going to have a little more say as to what you can and can't do on the improvements. Make sure if you have any question on whether or not you're working on an historic property, just reach out to your local government, your city or your county, and see if that property shows up on the historic structure list. If it does, make sure you go through the right channels, because it can be a headache and something that the fines and fees will cause you to lose money on the project if you end up just working on it and get lazy and don't check. So make sure that you are protecting yourself from that. Know whether your property is on the historic structure list or not. Let's talk about mechanics liens, also known as mechanics and material liens. This is a claim for payment of service or materials furnished. Now, some contractors, a lot of times this comes from contractors. Some contractors like to pull a lien just as a matter of course as they're working on your property, and then they'll release the lien once they receive payment in full and that the project's done to your satisfaction. Some contractors only use this as a remedy. So if there's a dispute on payment at the end of a project, they can pull a lien to make sure that that's resolved before you're able to sell the property. But a mechanics lien will prevent you from being able to sell the property without fully satisfying the lien, which is usually the money that's due to the contractor that pulled the lien in the first place. It is registered and recorded on the title of the property, and no title company will move forward until those liens are satisfied. So make sure that you're taking care of your contractors. We've got a whole module where we're going to talk about that, but just important that you know what that is going into it. A mobile home, let's talk about that. Often called a trailer home, mobile homes are the most complete and least expensive type of manufactured homes. They are normally semi-permanent and anchored and connected to utilities. So anything that had wheels or anything that was built off-site and transported to its final location would be considered a manufactured home. Mobile homes are the simplest form of that. A lot of times they have wheels that you just cover up with a skirt once it's parked where it's gonna stay for most of its life. So if you've got a mobile home, there are some different rules around financing, around permits, and other things. So make sure that if you're working on a mobile home or a manufactured home, that you're aware of the changes in building code and the requirements there, because they are different than standard construction homes. Let's talk about seasoning. This is an issue that lenders have with persons quickly selling properties or refinancing at a higher amount than the original purchase price. The sale or refinance is not seasoned, so the investor must often justify the higher price to get qualified for the loan based on a higher price. So again, translation for that. What this means is when we go back to chain of title, if you remember, we defined that a few slides ago. Chain of title, it also lets you know, the chain of title also lets you know how long each owner owned the property for. So if you've got a situation where you bought a property and 2 months later you fixed it up and you put it back on the market and you're looking to sell it, and an investor comes in and the bank, or excuse me, not an investor, a buyer comes in and wants to purchase the property to live in, and their bank that they're working with to get their mortgage says, hey, we need a seasoning period for the previous owner before we can turn around and give them their asking price. That happens sometimes. Now, nowadays, I haven't seen seasoning periods for sellers as much as I've seen seasoning periods for refinance. In a lot of cases, I've seen issues where, as a buyer, your buyer comes in and they purchase the property and they get a new mortgage and then they want to refinance. And the bank says, well, you can't refinance for 6 months because that's our seasoning period. So it's just a period of time that you're required to hold a property and usually it's according to the bank's requirements. So just be aware that seasoning can be an issue. It can be an issue for you as an investor with your future buyer's mortgage. Not likely nowadays, but I have seen it. And then it can also be an issue if you've got a mortgage that you want to refinance on like a rental property, right? There needs to be seasoning for your previous loan that you got. Let's talk about subchapter S corporations, often called S corps. This is a form of business entity and is a combination of a general corporation and a partnership. Stockholders enjoy the limited liability of a limited partnership, but can avoid the double taxation of a C corporation. However, S corporations are limited to 75 or fewer shareholders. Now, my best advice, anytime you're looking at creating an entity, always talk to an attorney, because your goals might fit better in one entity versus another. Sometimes you need a subchapter S corporation for your tax strategy, or sometimes an LLC might work better for both your tax strategy and your asset protection strategy. So you want to be in touch with both your accountant and your attorney as you're deciding what types of entities to use. This is just one that is often used for people who do fix and flips at scale, multiple at a time, because there's some tax advantages by doing it this way that we will talk about later on in this course. But keep in mind, an S corp is kind of a hybrid of a normal corporation and a limited partnership. It gives you the flexibility of being able to bring partners in potentially who have money or other value, and be able to operate out of and run your income from your fix and flip properties through. So just one of many entities that you can use. Subcontractors, let's talk about that. The provider of a specialized construction or improvement service. The subs are usually answer to a general contractor who supervises and directs the entire project. Typical subcontractors include plumbers, drywallers, masons, painters, plumbers, HVAC specialists, electricians, etc. I said plumbers twice, but you get the idea. So these are subcontractors. Usually these relationships are handled by your general contractor. Unless you decide to act as the general contractor on a project, then you're going to be working with the subcontractors directly. Let's talk about title insurance policy. This is an assurance agreement issued by the title company to indemnify the owner against losses arising from title defects. The title company issues such a policy after conducting and reviewing a title search. Most common types of policies issued by the title companies are the lender's, owner's, leasehold, and certificate of sale policies. So to break it down, a title insurance policy, we talked about the chain of title. If the chain of title is not complete, meaning they don't show at some point in that chain of title, let's say one owner 20 years ago didn't actually complete a sale, but the title transferred anyway in the case of a divorce or whatever the case might be. And they come back 20 years later and say, hey, wait a second, we have a claim to this property. The title insurance covers any of those types of things if they were to happen. So somebody that comes back that was on the chain of title previously and says, hey, we have a claim to this property and here's why, The title company is supposed to find that, but if they don't, the title insurance policy should cover any damages that are caused by that. So make sure that you have a title insurance policy in place on all of the properties that you own, because you never know. I've only had this in the 60 plus fix and flips that I've done. I've only had this pop up once where there was a discrepancy on the chain of title, and some previous owners had a claim to the property, but it was handled by the title insurance policy. So you want to make sure that those things are covered. Make sure you have a title insurance policy on each and every deal that you do. And then the last definition we're going to cover here is a title search. This is the examination of public records to determine past and current information about the ownership of a property, usually with the goal of determining who has the rights to the property. So chain of title comes into play here. Title search is the search that they do to make sure that your chain of title was executed correctly in every one of the transactions in the past on that property, so that you shouldn't have a problem with your ownership in that property once you take possession of it, once you purchase it. So that title search is the process that they use, and then if there's any discrepancies there, that should be covered by the title insurance policy. So hopefully that makes sense. Hopefully you guys have a good grasp of these definitions, because we're going to be talking a lot about those in future modules as we jump in. That wraps up Module 2, definitions of our fix and flip class. Next, we're going to be discussing red flags, the things that you should look out for as we get into Module 3. And there's actually a really cool twist to discovering red flags that I'm excited to share with you. We're going to do that in the next module, so I will see you guys over there.